In 2026, a growing number of Americans are asking a serious question: is the United States heading toward a recession, and is an economic slowdown already beginning to take shape? Economic uncertainty has once again become a major topic of discussion across financial markets, business communities, and households. While some indicators show resilience, others suggest warning signs that cannot be ignored. Understanding whether America is entering a recession requires looking closely at multiple factors, including inflation, employment, consumer spending, interest rates, business investment, and global conditions. A recession is generally defined as a significant decline in economic activity spread across the economy lasting more than a few months. It is typically visible in real income, employment, industrial production, and wholesale retail sales. In 2026, the U.S. economy presents a mixed picture. Growth has slowed compared to previous expansion years, but it has not completely collapsed. This gray area between steady growth and full recession is where much of the debate exists. One of the biggest contributors to recession fears is the impact of high interest rates. Over the past few years, policymakers raised interest rates to combat inflation. While these measures helped reduce rapid price increases, they also made borrowing more expensive. Higher rates affect mortgages, car loans, business financing, and credit card debt. When borrowing becomes costly, consumers and companies often reduce spending and investment, which can slow economic momentum. Inflation remains a central issue. Although inflation is lower than peak levels seen earlier in the decade, prices for groceries, housing, healthcare, and energy remain elevated compared to pre-inflation years. Many families feel financial pressure even if official inflation numbers appear moderate. Reduced purchasing power affects consumer confidence, which plays a vital role in economic stability. When people feel uncertain about the future, they tend to save more and spend less. The job market in 2026 shows both strength and weakness. Unemployment rates remain relatively low compared to historical recession periods, but hiring has slowed in certain sectors. Technology companies that expanded aggressively have trimmed payrolls. Some manufacturing segments show signs of contraction, while healthcare and service industries continue hiring steadily. A key question is whether these sector-specific slowdowns will spread more broadly across the economy. Consumer spending drives a large portion of the U.S. economy. In 2026, spending patterns have shifted. Households prioritize essential expenses such as housing, utilities, food, and transportation. Discretionary spending on travel, entertainment, and luxury goods has softened in some regions. Credit card balances have increased for many families, raising concerns about long-term debt sustainability. If consumers pull back significantly, overall economic growth could weaken further. The housing market also plays an important role in recession discussions. Elevated mortgage rates have cooled home sales and construction activity in several states. While a dramatic housing collapse similar to past crises has not occurred, affordability challenges have slowed transactions. Real estate often influences broader economic activity, including construction, employment, home furnishing sales, and financial services revenue. Business investment trends provide additional insight. Companies facing higher financing costs and uncertain demand often delay expansion projects. Small businesses in particular feel pressure from rising operational expenses, including rent, wages, and supply costs. Some entrepreneurs remain optimistic while others adopt a cautious approach, focusing on cost control rather than growth. Stock market volatility adds another layer of complexity. Financial markets react quickly to economic data, policy decisions, and global events. In 2026, market swings reflect investor uncertainty about future earnings, interest rate paths, and geopolitical risks. Although stock fluctuations do not automatically signal a recession, they influence wealth perception and consumer behavior, especially for households invested in retirement accounts. Global economic conditions also matter. The United States operates within an interconnected global system. Slowdowns in major economies, trading partners, supply chain disruptions, or geopolitical tensions can affect U.S. exports, imports, and investment flows. International energy prices, currency movements, and trade policies all shape domestic economic outcomes. Government spending and fiscal policy provide partial cushioning against downturns. Infrastructure projects, defense spending, and social programs inject money into the economy. However, rising national debt levels spark debates about long-term fiscal sustainability. Policymakers must balance supporting growth with maintaining financial stability. Another factor influencing recession concerns is wage growth. While wages have increased in certain industries, they have not always kept pace with higher living costs. Real wage growth adjusted for inflation determines whether workers truly gain purchasing power. If wage growth slows while prices remain elevated, consumer demand may weaken. Corporate earnings reports in 2026 reveal uneven performance. Some large companies maintain strong profits through cost management and global diversification. Others experience declining margins due to softer demand and higher input costs. Layoff announcements in specific sectors raise public anxiety. Even if overall unemployment remains moderate, the psychological element of recession expectations should not be underestimated. If businesses and consumers widely believe a recession is coming, they may act more cautiously, which can itself slow economic activity. Confidence indicators often provide early warning signals before official data confirms a downturn. It is important to distinguish between a technical recession and a growth slowdown. An economy can grow at a slower pace without entering a formal recession. Analysts debate whether current trends represent a temporary cooling period following rapid expansion or the early stages of a broader contraction. Regional differences across the United States further complicate the picture. States with diversified economies, strong population growth, and stable industries may continue expanding even if others struggle. Energy-producing regions, technology hubs, manufacturing centers, and tourism dependent states each experience unique cycles. Small businesses often serve as early indicators of economic stress. Surveys in 2026 show mixed sentiment. Some owners report steady sales while others face declining customer traffic. Access to affordable credit remains a challenge, particularly for startups. When small businesses reduce hiring or close operations, local employment can be affected quickly. Another critical aspect is household savings. During earlier stimulus periods, many Americans built savings buffers. Over time, however, those reserves have declined for some families due to persistent high costs. Reduced savings increase vulnerability to job loss or unexpected expenses. Credit conditions also shape recession risk. Banks in 2026 maintain tighter lending standards compared to expansion years. While this protects financial institutions from excessive risk, it can restrict capital access for consumers and businesses. Lending activity is a key channel through which economic momentum either accelerates or slows. Energy prices contribute to economic sentiment as well. Fluctuations in oil and gas prices influence transportation costs, manufacturing expenses, and consumer budgets. Sudden spikes can intensify inflation pressures, while declines may provide temporary relief. Looking ahead, experts present different scenarios. Some predict a mild recession characterized by modest job losses and limited output decline. Others anticipate a soft landing where growth slows but avoids contraction altogether. A third group warns that external shocks such as geopolitical conflicts or financial instability could trigger deeper downturns. For everyday Americans, the technical definition of recession matters less than personal financial reality. If wages feel insufficient, job security appears uncertain, and expenses continue rising, households perceive economic hardship regardless of official classifications. In evaluating whether America is heading toward a recession in 2026, it is essential to monitor leading indicators including manufacturing activity, consumer confidence, housing starts, business investment, and employment trends. Economic cycles are natural, but their severity varies depending on policy responses, structural strengths, and global influences. Ultimately, the U.S. economy in 2026 stands at a delicate balance point. High interest rates have cooled inflation but slowed momentum. Employment remains relatively stable, but hiring growth has moderated. Consumer spending continues but shows signs of caution. These crosscurrents create uncertainty yet do not confirm an inevitable collapse, whether the coming months bring a mild slowdown or a deeper recession will depend on how businesses, households, and policymakers respond to evolving conditions. Flexibility, strategic planning, and careful monitoring of economic signals will shape the outcome. The story of a potential U.S. recession in 2026 is still unfolding, and its final direction has not yet been written.